So everybody keeps saying that buying a house is the American dream. And I want to explain to you why, as of recently, that's a complete lie. It's probably the worst financial mistake that you can make. I think it's financial suicide right now. I want to talk about why renting makes more sense and why these 50-year mortgage loans are probably the worst thing that you can do to yourself, especially if you're not an investor. I'm not going to talk about the investing side. I want to talk to the average person that essentially is going to be going through this. There's a couple of things that I want to touch base on, but if you can do me a favor and like this video, it helps push this video out to essentially a whole lot of other people. That way they can capture this information. I really appreciate it. With that being said, the 50-year mortgage loans that they're pushing out right now may seem essentially something that is attractive, right? And one of the reasons why is because when you get a loan, there's different terms, right? Think of a car loan. You have 3-4 years. Typically a car loan is 7 years. The longer the loan you have, the higher the interest you get. So in some instances, it might make a little bit more sense because you'd be saving a couple $100s on a $20,000, $30,000 vehicle loan. But the issue is with a house loan, I'm going to show you guys here in a second, you will be saving money, but the interest on a house loan is absolutely absurd. Now, I want to show you guys my screen right now. So one of the first things that I really want to touch base on is why the math doesn't make sense, right? So I'm going to give you two examples. Example one is on a $400,000 house on a 6.5% interest rate. On a 30-year loan, you're paying a little over $2,500, right? And over the course of the 30-year loan, your interest is going to roughly about $510,000. This isn't with a down payment. This isn't with PMI. This is just roughly $400,000 on a 6.5% interest rate. So over the life of the loan, that's essentially what you're paying. Now, when you put it into a 50-year mortgage loan, your monthly payment does drop down. But the thing that nobody's telling you is that even on a 6.5% interest rate, and keep in mind, the longer the loan, the higher the interest rate. So on a loan that's longer, you're going to be paying more interest. But for the sake of math, I'm just keeping everything the same. That way you can see how it just doesn't make sense, even in a scenario that you're never going to get, essentially that's going to be better for you, right? So it would be better if you have a 50-year loan for the same rate that you're going to get a 30-year loan. So with that being said, 50-year loan, you're paying $2,255, and in interest, you're paying $953,000. So you'll be saving about $273 a month. But the thing is that over the life of the loan, you're going to be paying $443,000 more in interest. And although you may not think about that right now, you may just be thinking about the savings on the monthly payment. You really have to ask yourself, does $273 a month really make sense when you're paying $443,000 in interest that you're giving straight to the bank? You're not paying in principal. And we're going to talk about that a little bit right now. What's the principal and what's the interest? Because there's some things that you do not know. Now, for my second example, for something that's going to be a little bit cheaper, if you have $348,000, $350,000 house at a 6% over a 30-year loan, you're paying $2,086 a month. That's $403, a little over $403,000 in interest. Now, if you expand that over a 50-year loan, you're now paying a little over $1,800 a month. That is $751,000 in interest. Your monthly payment drops $254, but then you're paying damn near $350,000 extra. That's extra in interest. And that is absolutely absurd. Now, here's the thing. When you're looking at it from anywhere from a 7 to a 10 year, right? When the average person buys a house, they're typically in that house for about 7 to 10 years before they move, especially if you're a first-time homeowner. It's very rare for somebody to buy a house and they're in that house for 30 to 50 years. Now, back in the day when our grandparents were buying a house, they were staying in their homes, right? They're probably still in that same home that they were in when you were a kid, and it's probably almost paid off. Now, when it comes to the new age, a lot of people don't stay in their homes, and that's something that I want you to really pay attention to, because here's the thing. Over the course of 10 years, right, you only pay off 4% of the principal over the course of the 10 years. And after 20 years, you only pay off 11%. I want you to really think about that. So when it comes to a regular typical 30-year loan, after 20 years, you would have paid off 46% of your principal. And now what's principal versus your interest? For those of you who don't know, so when you buy a house, You're thinking that if you have a $2,500 payment, then when you pay those $2,500, that let's say 6.5% is going to go to interest and the rest is going to go to principal, which is the balance of what you owe. So if you buy a $400,000 house, that is the principal with no down payment, anything like that. That is the pure what you're borrowing from the bank without any interest. When you make your monthly payments, your $2,500 doesn't go straight into what you owe. The bank wants their money back. And when it comes to a loan, they take their money up front. So if you pay $2,500 a month on a 6.5% interest, a big chunk of that is going straight to interest. You're probably paying $2,200 in interest, and $300 of that goes straight into the principal. So you only buy down your loan by a little bit. Now, on a 50-year loan, after 20 years, you would have paid only 11%. After 10 years, you would have paid only 4%. If you would have been on a 30-year loan, after 20 years, you would have been paying 46% off of your loan. Now, you pay the most interest when you owe the most money. What does that mean? Here's the thing. On a $400,000 house at a 6.5% interest, after 30 years, if your monthly payment is $2,528, let's say, the first month you're paying $2,167 in interest, and only $361 of that goes into the principal. So even though you paid a little over $2,500 of the loan, your loan only shrank by $361. That's why in the first 5 to 7 years of you paying off your mortgage, it doesn't feel like you're really paying anything off, because you're really not, because you're paying the bank first for them lending you the money. Now, after you pay every month, your interest slightly starts to go down. So on the second month, you'll owe $399,639 instead of the $400,000. So instead of calculating 6.5 on the 400, you're calculating 6.5 on the 399. So I want you to think about this real quick. Over 30 years, you pay almost double the home price in interest. That is absolutely insane. And that's on a 30-year, right? So halfway through a 30-year mortgage loan, you should owe half of the house, is what a lot of people think, and that's not true. At 15 years, when you're in 15 years of a 30-year mortgage, the average homeowner still owes about 70 to 75% of the original balance. And you don't really hit the halfway mark of what you owe in your principal until you're probably in year 20. And that's how front-loaded interest works. The bank wants to get paid first. So again, using that as an example, if you borrow $400,000 for 30 years at a 6.5% interest, again, your monthly payment is going to be a little over $2,500. Over 30 years, you're actually going to be paying $910,000 on a 30-year loan. And your total interest is going to be $510,000. So you pay more in interest than what you're paying for the house. Now, I want you to take a look at a 50-year mortgage loan and why that's even worse. If you stretch the same loan over 50 years, your monthly payment drops about $250, right? But then you're paying $900,000 plus in interest, and you're paying over $1.3 million for a $400,000 house. That doesn't make sense. That's financial suicide. I want you to look at it side by side. A 50 versus a 30-year mortgage loan after 7 years, right? Because after 7 years, typically you may want to move into a bigger house, you may have started a family, or maybe you want to downsize. Whatever the case is, I want you to look at it after 7 years, because typically after you buy a house, that's when you want to move. When you want to buy a house, you want to think about the long term, right? You're thinking about an investment. But here's the thing. Again, a lot of people don't stay in their homes after 7 to 10 years. They move. On a 30-year mortgage loan, right? You would have paid $47,000 towards the principal. You would have paid $146,000 in interest, and taken into account maybe appreciation, maybe inflation, equity, you would have roughly had $153,000, right? So on a 30-year loan with 3.5% down, at a 6% interest, you're paying about $14,000 as far as your down payment. And over 7 years, you would have paid $47,000 in your principal, which means the remaining balance essentially of that 30-year loan would be $338,000. Now, when you take into account a 50-year mortgage on the same $14,000, as far as your down payment, after 7 years, you would have paid $12,000 off your principal, which means if you would have moved after 7 years, your loan would have still been $373,000. That is absolutely insane. So you really have to ask yourself if buying a house on a 50-year mortgage is the smartest financial decision that you can make. Because after 7 to 10 years of you wanting to move, the reality is you would owe so much more on that house than what you would have thought of, that it just doesn't make sense. It makes more sense renting, saving that difference. I mean, you can rent for $2,000. You can even get into a house for $2,100,000 if you're renting a house. And that would probably make more financial sense than getting into one of these traps. And I say a trap because that's exactly what it is. The bank makes money. You don't own property. You're going to be locked into a 50-year loan for the rest of your life. I mean, you're not going to own anything. By the time you pass away, you're going to be handing down debt. There's nothing that's positive about a 50-year loan. And I'm just being completely honest. Again, this is for the average person who's watching this video. If you're an investor, you can leverage it a little bit, but I'm not talking about that. I'm talking about the average person. So I'm very curious to hear your comments down below. I want to know your thoughts. I want to know if you think that I'm wrong. I want to know if there's something that I'm missing that maybe I'm not paying attention to. But at the end of the day, I'm definitely curious to know what you're thinking. Comment down below, like this video. Thank you guys so much for watching. It helps out so much. Until next time, love you guys all. Peace.